Hello there, I'm Diabo Sito with your market update. U.S. stock index futures fell on or at the close of business trade as investors assess the implications of the federal government shutdown, which threatens to disrupt the release of key economic data as well as complicate the Federal Reserve's policy path. The shutdown, which is dependent or independent analysts warn that could last longer than the budget-related closures of the past. It comes at a time when markets are leaning heavily on hopes of a dovish Fed policy and after equities posted the second straight quarter of gains. While shutdowns have not derailed markets historically, the current episode coincides with a critical period when stock valuations are elevated and sentiment is fragile. The Dow Jones is down 0.6%, the S&P 500 is down 0.7%, and the Nasdaq index is down 0.9%. Back home, the all-share index is currently down 0.4%, sitting at 107,992. And when we look at our commodities for this lunch hour, the rand is trading at 17 rands at 21 cents to the dollar. It's at 23 rand 16 to the pound sterling, at 20 rands 22 to the euro. And a quick look at our commodities: gold trading at $3,890, while platinum is at $1,582 an ounce, and the price of Brent crude oil moderates today at $66.29 a barrel. All right, our market analyst for today is Michael Traherne. He's a portfolio manager at Vestec. Michael, thank you so much for joining us on the markets. I hope you're having a good day. We've been keeping quite a stern eye on that U.S. government and developments happening there, where they've entered that partial shutdown after they Congress failed to pass legislation to fund federal agencies for the next financial fiscal year. What risks does this carry if it is prolonged for longer, not only for the markets, but the U.S. economy as a whole?
Yeah, afternoon, and afternoon to your viewers. The big issue there is that, well, I suppose the good news is all essential services are still operating. So the economy can limp along. The last time that this happened, it cost 120,000 jobs in the U.S. economy. That's not to say that those jobs weren't later recreated, but it just delayed the growth, which isn't good news. But overall, the market's not too worried about this. This is the fourth shutdown in Trump's two terms as U.S. president, and he's only halfway through his second term. So it's, we've seen these before. He actually set the record for the longest shutdown of 35 days. So he's quite a way away from that. I think markets will start getting jittery if this starts getting into 2-3 weeks in terms of length. But for now, nothing major. The biggest issue for markets is access to information, because things like the Labor Statistics Bureau don't report numbers when it's shut down. So flying blind for a little bit, but nothing to panic about yet. Yeah,
I'm quite curious about, should that 2-3 week period that you say that market would now then start being worried about happens, and we don't get, for instance, the jobs numbers and the interest rate numbers, what would happen in that case?
Yeah, generally increased levels of uncertainty means slightly lower stock prices. You would see a weaker dollar and probably slightly higher gold prices. But none of this shutdown isn't material for the long term. It's material for the short term. But high levels of uncertainty, no one likes that, particularly the markets. So yeah, fingers crossed that the Democrats and Republicans can find some sort of compromise.
Yeah. Coming back home, Capitec has reported a 26% increase in headline earnings, and they've also declared an interim dividend of 26%, or it has gone up by 26%. And when I was reading through their results presentation, 65% of their income is now coming from operations, now comes from other business than credit. What do you make of these results, and what does this tell us about the changing face of the bank as we know it as a bank that used to prioritize more of the unsecured lending?
Yeah, I mean, Capitec's a world-class bank, and I personally bank with them, and they're just easy to use, and the technology works, which I suppose you can't say for all the South African banks, particularly the older ones with legacy technology. And you see this come through in the numbers. They're now the biggest bank in South Africa with over 25 million customers. But their key is using that customer information to provide world-class products. And they say because they can see so much of what's going on, they can make better informed decisions about what credits to lend to who and at what rates. It's also worth noting that they've got a business division now that's growing nicely. I think it's 2 or 3 million clients.
Yeah.
And then they've got all their bolt-on stuff. So the Capitec Connect, the airtime business, that brought in 165 million rand this year, where last year it was only 69. So all these small extra businesses that they keep adding on to a very large customer base means more money. And management point out that because they've got these economies of scale, they can do more with a lower cost base. And that's good for the company and good for customers.
Yeah, seeing that a lot more people bank with them, including yourself, like you say, what do you see it looking like in the future? Do you see, technological advancements coming through and it really being a bank of the future as we can imagine banks to be?
Yeah, the South African banking environment's going to get a lot more competitive in the years to come. You've got Old Mutual, who's going to launch their bank at the end of the year. You've got Shoprite, who are saying that they want to do some banking themselves. And then you have international players. I think it's Monza, I think, or Revolut, who want to open a South African business in the next year or so. So there's a lot of technologically advanced companies who want to start banking in South Africa. More competition means lower prices, means better service, and that's good news for the customer. But I think Capitec is so entrenched at the moment, and their standard of excellence means that they're going to keep their customers. Maybe growth slows down a little bit, but so far so good. Yeah,
and lastly, ABSA released their Purchasing Managers Index, which has gone up by 2.7%, or rather points. Michael, they've gone into that expansionary territory of more than 50 basis points, and it is for the second time this year. Do you think that this is a time where we're seeing major changes in the manufacturing environment and a real turnaround looking at these numbers?
Yeah, so it's worth pointing out that the PMI reading is generally quite lumpy and volatile, and that just reflects manufacturing, which can be a bit volatile given that there's so many moving parts, leads and lags. Any delays anywhere around the world impacts it. As you mentioned, this is only the second time this year that this reading has showed an expansionary industrial base for South Africa, and that's a problem. We're 9 months down, and only 2 of them we've been growing. The rest of it we've been going backwards. The good news, though, is that the growth in this reading came from the domestic economy.
Yeah.
So that shows things on the ground are getting better. What didn't help was exports were a bit weak. A US government shutdown's not going to help that either.
Yeah.
And global tariffs, particularly from the US, is going to slow that down even more. And then probably the most worrying is that managers interviewed said 6 months from now they not positive. So you've got a gloomy outlook from your current purchasing managers. Our economy needs growth, and this reading is showing some growth, but very, very fragile.
Sure. Michael Traherne, thank you so much for your time. Michael Traherne was our market analyst for today. He's a portfolio manager at Vestec.